Have you watched the recent blockbuster movies? You may notice that even without a compelling story, they manage to attract a massive audience solely due to the star's charisma. It's what we often refer to as the star's X factor. Imagine two Formula One drivers competing in identical cars, yet achieving varying levels of success. The difference in their performance can be attributed to their distinct racing strategies. It's a reminder that success in Formula One isn't solely determined by the car. It's the driver's strategy that truly sets them apart. Call it the X factor of the driver. Similarly, if you can dissect stocks with an X factor, it'll help you build a portfolio that beats the benchmark index Nifty50. We will look at one such index today with an X factor. We will see how the stocks are selected for the portfolio and what are the stocks that makes it special. In investing, a factor refers to an attribute that influences a stock's performance going up or down. The widely followed Nifty50 index comprises the top 50 companies in the market based on their free float market capitalization. Consider an index that is crafted around a factor which enhances the portfolio performance beyond the Nifty50 market index. What are the specific factors that contribute to this outperformance over the broader index? To understand that, index investing is a passive investing where your portfolio mimics the stocks in the index and it generates similar return to the index. This is low cost. Active investing is when a fund manager deviates from the index composition and tries to beat its performance. The cost is higher with expectation of a higher performance. Then you have the middle path of factor-based investing, where you aim to beat the broader index at low cost using some rules or factors. There are 5 well-known factors which aims to capture extra returns. The first is momentum factor. Aims to invest in stocks that are in upward momentum and sell them when the direction changes. Volatility factor aims to invest in stocks that exhibit lower price volatility, thereby managing the risk better and hence an outperformance over the broader market. Quality factor invests in highly profitable companies with very strong fundamentals. Value factor invests in undervalued stocks based on metrics such as low price to earnings or low price to book. Size factor. Here the focus is on investing in smaller cap stocks with historically higher returns than the larger cap counterparts. The index we are discussing today is the Nifty Alpha 50 index. In simple words, alpha is expressed as the excess return in relation to the broader market after adjusting for risk. It invests in stocks that are showing higher alpha compared to the market and sells the stock when the alpha diminishes. Alpha is the difference between the actual return of the stock and that of the benchmark, risk being the same. Here is how the stocks are selected. Those stocks are eligible which have completed a year of listing history. They are selected only from the top 300 stocks by size or market cap. Alpha scores of these stocks are calculated and the top 50 companies with the highest alpha are selected, with contribution size being proportional to their score. This exercise is repeated every 3 months. March, June, September and December every year. The stocks are rebalanced. We will look at the stocks that have made the cut in September, most recent rebalance. But before we go there, why would you even want to add this index? First, historically, this index has outperformed the broader index by 5% every year. That's a big outperformance. The 3-year rolling return chart, Nifty Alpha 50 index has generated 17% yearly compared to 12% of the Nifty 50. Over a 5-year rolling period, similar outperformance of 5% is seen. This is a high risk, high reward approach. It experiences short-term fluctuations. Over the longer time horizons, it shows reduced volatility and higher alpha generation. Second, during the bull phases, this strategy has generated excess return over the Nifty 50 while being more volatile during the bear phases. Third, the mid cap and the small caps do well during a bull market and the large caps tend to do well in bear phases. This alpha factor index adapts the stock's rotation to reflect these changes automatically. Fourth, different sectors do well during business cycles. For example, in September, financial services did very well, whereas healthcare did poorly. But in January, healthcare did very well and financial services did poorly. The alpha factor index changes the composition of the portfolio based on these changing cycles, and it captures the up move of stock and limits the downside. How many stocks get bought and sold? On an average, 12 stocks are replaced every 3 months. During the rebalance, average churn is 35%. What are the stocks as of September rebalance? These are the top 10 stocks that made the cut. So adding an alpha strategy can potentially increase the portfolio returns, as you can see in this graph. While alpha has beaten the Nifty 50 clearly for a 10-year period, even a mere addition of an alpha strategy to your Nifty portfolio has increased the return to 18% versus 15% of the Nifty, while keeping volatility the same. In summary, alpha factor has delivered higher returns versus the broader index. It's a proxy for sector rotation strategy. Adding alpha to beta increases the portfolio return. The limitations are it adapts to the changing market conditions with a lag. It can witness longer and sharper drawdown. As with most things in life and in investing, alpha is also cyclical. If you're an investor with high risk profile, interested in exploring factor-based investing, you can research further the Alpha 50 Index Fund. If you like this video, please do consider sharing it with your friends, like it, and subscribe to this channel.